3, 2, 1. Jerry's taking a drink. Welcome to the show.
Welcome to the show. So let's just say this on the front end.
Are we going to piss some people off?
No, not on the show. Maybe right now, but not on the show.
We're on the show. What do you mean?
I mean, when they see the show.
Oh, okay.
How about that? So this is. I just want to say this about that. It is Wednesday at 5:00 p.m. So the Fed.
You're letting them see behind the curtain.
That's okay. They can see behind any curtain they want.
Yeah, we're transparent.
The Fed met yesterday and today.
I'm going to take a drinky.
Fed met yesterday and today. Raised a quarter point, which is what everybody expected. The market, it was, futures were way higher. Market was up, 2% at some point. At some point, it was negative for the day. It finished at the top of the day's trading range, right around 2%. The Fed chairman in the comments afterward, at some point said, "I don't have a crystal ball." And I was literally laughing out loud in my apartment. I mean,
no crystal ball.
Literally out loud laughing. My neighbors thought I was nuts, I'm sure.
You probably already think you're nuts.
Well, the Fed chairman doesn't have a crystal ball. Imagine that.
Imagine that.
Yeah.
How could he?
He has tools.
And he's a pretty smart fellow.
Yeah. I mean, some would argue, but yeah.
I mean,
he
made
of course.
there.
No, yes, right.
You know?
Yeah. Empirically, he is a smart guy. No doubt about it, right? Whether or not you agree with what the direction he's taken and all that,
agree with
that's
his
fine.
opinion to say he's a smart guy.
Well, he's a smart guy. Yeah.
Yeah.
And he doesn't have a crystal ball. I love it. So, and it's actually
happens to be the topic of conversation for this show.
It is. So we're doing this on Wednesday. We have a lot of stuff going on later this week.
When you guys see this show, Conan will be in South Dakota.
Yeah.
So
it's probably snowing in South Dakota, bro. I don't know.
Please don't do that to me. Snow has been following me everywhere I go. Was in Colorado and then came back here. Snow followed me, and then please don't let it snow in South Dakota.
Yeah.
But yeah, so we were going to be in different places, and it's much easier for us to do it together than try to do it from a hotel room. And Jerry just had to happen to have this great topic.
Yeah.
So
I think people get a kick out of this. Okay, so here's what we're going to do. We're going to call this the Crystal Ball Show. Okay. I got 4 very well-known people in the financial industry on both sides of the fence, and they do forecasts. So I got 4 bulls and 4 bears that are doing forecasts for 2022. I'm putting this together here, middle of March, and the market's down. And so to find bulls currently is very difficult. Okay.
I wonder why.
I mean, if you get on Google and YouTube and search around and try to find financial analysts that will give you a bull case right now, I mean, I've spent the last couple of days trying to find it. And
but they were just a few months ago.
A couple months ago, there were plenty.
Look at that.
Right? We're going to look at the bulls first, and then the bears. And as you would expect, there's plenty of bears that are coming out of the woodwork now, right? Coming out of the forest because the market's down. All right, and then we're going to look at, everybody knows the price of gas is going up. What is going on with gold? I thought gold was a hedge against inflation and all that, and food prices are going up. So we're going to take a look at a chart.
You didn't just think that. I mean, most people think that gold is a hedge against inflation.
Yeah, that's what people think. Yeah.
Exactly.
And food prices, everybody knows food is ridiculous. And then, so since we're doing this on Wednesday, I don't have the charts for the week, but the only chart that matters is not going to change between now and Friday. So we're going to take a look at that. Okay. So the bull case, we got these 4 guys: John Stoltzfus, Peter Oppenheimer, Ken Fisher, and Larry Williams. So John Stoltzfus is the chief investment strategist at Oppenheimer. If you go to this link, and I'm going to remind Conan later, but we're going to put...
We will put those links. We don't always do that because I forget, but we will put the links, because these are YouTube videos. I want you guys to watch them because they're actually really interesting.
Yeah.
Not to just hear Jerry's bullet points on this, but hear the conviction sometimes in these predictions.
Oh yeah. No, when most of these guys, when they forecast, they're not kidding. They're like, this is absolutely going to happen. Like it's, gravity. It's going to happen. So Peter Oppenheimer. So again, these are just bullet points that I took out of watching these videos. Okay. Peter Oppenheimer, Chief Global Strategist at Goldman Sachs. Goldman Sachs, they're one of the they run the world. This came out on November 16th, 2021. And again, it's because I couldn't find anything current for the bulls.
If there is an Illuminati, they're part of it.
They are them and BlackRock, I'm telling you.
Gotta be, yeah.
Yeah.
I don't know.
BlackRock is the Illuminati, and he's got some subordinates, and Goldman Sachs is definitely one of them. So Goldman Sachs comes out and puts a price target on the S&P 500 at 5,100 for 2022. Okay, and the justification is the economic cycle is slowing around the world, but it's still intact, right? GDP growth has been 6%, right? 6% in 2021. It's expected to be 4.5% in 2022, but that's still enough GDP to continue the market to move higher. So it's slowing, but still above the long-term trend of the growth rate. Inflation's picking up. Policy rates are at all-time record lows. That means the Fed policy rates. So this is back in November, before the Fed came out in January and said that it was going to start raising rates. So you got to take all of this in terms of the dates. At that time, policy rates were at all-time record lows. Real interest rates are negative. Okay, so what that means is the difference between inflation and what you can get in bonds is negative. So you're losing money in bonds, which is going to push investors into real assets, meaning real estate or stocks or other things that we consider as the market that would go up, right? So because the real interest rate, the difference between inflation and what you can get as a yield in bonds is negative, it pushes investors into stocks. The dividend yield, right? So when we say yield in terms of rates, that's one thing. The dividend yield is what you get back from stocks that you invest in. So maybe, Apple has a 1% yield. I don't know this to be true. I'm making this up. Let's say Apple has a 1% yield, and I don't know, Procter & Gamble has like a 3% yield. So the yield is what you get on an annual basis put back into your account from those companies. So dividend yields on stocks are still positive, and real rates are negative. So that's why they think that people are going to be pushed into the stock market, and that's why stock prices should continue going higher in 2022. All right. So that was the Goldman Sachs, the synopsis sort of that video. Definitely go check it out for yourself. Larry Williams, legendary trader, author. He's got a bunch of books out there. He's on stockcharts.com all the time. He's created a couple of different market indicators, right? Williams %R. He created another thing called the Ultimate Oscillator. So he puts out a more recent forecast. This was on January 7th, 2022. So he doesn't give us a specific price target, but what he's looking at is cycles, seasonals, and valuations, right? And he says the Fed is the most significant factor in 2022. So again, we're back here at January 7th. It was literally the day after the Fed came out and said that they were going to raise rates. Perhaps he did his presentation, put it together prior to January 7th, and it just happened to post on January 7th. But he says the Fed is the most significant factor in 2022. He also says large deficits are good for stocks. So from a historical perspective, when the government spends money, that tends to push the stock market up, which is historically true. Interesting here, he says, a change in GDP does not predict stock prices. A lot of financial houses look at GDP as a really important measure of whether or not stocks are going to go up or down over time. And Larry Williams is saying that the change in GDP is not a good indicator of whether or not stocks are going to go up or down. So there's a lot of talk about, slowing growth and decreasing GDP, and he just doesn't think that that's a factor. Inflation, he says, is in place, and it was for the last half of 2021, and it will be through the first quarter of 2022, but then subsides, in his opinion, over the course of 2022, and that should be bullish for stocks going forward. He also says the probability of a U.S. recession is very low, and we're going to have a chart about that as to why he says the probability of a recession is low. He is concerned about a bearish yield curve. So I have a chart about that, and it's much easier to see it than to explain it. Okay. So he also focuses on something that we put out a while ago. It's this chart of the 2-year cycle. So every second year of the decade, I'm going to pull up that chart also and kind of show you what that is. So at the end of the day on his YouTube, which is this link, he says, stay bullish and buy the dips, buy into weakness, which would be the dip, right? And sell the strength. So if you're in a bear market, the market comes down, you buy when it's low, and as it comes back up, selling into strength. Then when it rolls over and comes down, buy into the weakness, sell into the strength, right?
I mean, we should point out that's very difficult to do in the TSP, right? I don't want anybody to lose track of that because a lot of times people like to buy the dip. I'm just putting it in perspective. Good luck if you're doing it within the TSP.
Yeah. So he expects the market to follow the 2-year cycle chart, which again we're going to show in a minute. And he, as of the 7th of January, he did not expect substantial rises in interest rates for the year, which, who knows? Maybe the Fed, obviously today the Fed rose by a 1/4 point with anticipation of another 8, I think, rate raises going forward for the year. Whether or not that happens, we shall see. So here's the bearish yield curve. This is obviously the price of the S&P 500 going back to 2000. So this is a long-term chart, right? The yield curve is this. If you subtract the 10-year yield from the 2-year yield, so you get a certain rate if you give the government your money for 10 years versus giving the government your money for 2 years. And if you buy a 10-year treasury bond, you're locking up your money for 10 years. So you expect to get a higher rate of return than you would if you were only locking it up for 2 years, right? So if the spread, the difference between the 10-year yield and the 2-year yield decreases, then the curve of that decrease, if the curve starts to flatten out and then come down, it's a sign of an upcoming recession, because people are demanding more of a return for short-term bonds. So a flattening of the yield curve, you probably heard it in financial news, flattening is bad, and if the yield curve turns negative, it's a very bad thing going forward for stocks. In terms of inflation, I took this off the Fed website, so it's not the chart that was on his video. What he talks about in the video is when the smooth U.S. recession probability line gets above 25, that's the level that we have to worry about getting inflation. So if you could zoom in on this, which I couldn't find a good way to do it, but if you could zoom in on this, you can see that at 25, these grayed in areas in here are recessions, okay? So if this line gets above 25, then the probability of recession goes up a lot. And over here, as far out as the data goes, is January 1st, 2022. So as of January 1st, 2022, there's no, basically a zero probability of recession going forward.
However,
I mean, I think if you watch the news, everybody is expecting there to be, not everybody, because there are people on both sides of the fence, but probably the majority believe that there is going to be a recession at some point here in 2022, if not 23 for sure. Yeah. So here's the chart of the two. So you average the second year of the decade, right? 52, 62, 72, all the way up to 2012. And if you average all those returns annually, this is what a chart of that looks like. And so the chart, as Larry Williams explains, it's not to define amplitude as much as timing and direction. So here we are at the beginning of January. We've had a big move down, which he would argue isn't inconsistent with this. This is basically flat, and we had on average, a big move down here from March into the middle of April. Is it possible that this year that move came a little bit earlier? Sure, that's possible. Maybe this move down that we've had is really the move down that on average would have happened in March into April. But the point, really the big point is, at the end of the year, the fourth quarter, he's expecting us to move to new highs, which is why he's saying buy the dip. Okay, so that's why he's in the bullish column. Okay, that's Larry Williams. Ken Fisher on a similar kind of line with Larry Williams. So Ken Fisher, if you don't have him in your feed, I'd be surprised. His advertising is unbelievable. I wish we could advertise like him. He's the founder of Fisher Investments. He's got a $200+ billion assets under management, and this is his forecast from January 22nd, 2022. You can see it at the link right here. So he doesn't give out a specific target for 2022, but he says, kind of like Larry Williams, he's expecting a big fourth quarter, possibly to new highs, right? He talks about the second year of the presidential cycle, right, which we're in right now, tends to be positive, right? 57% of the time, the year two is positive, okay? But the interesting thing is, it tends to be either up a lot or negative compared to the first year of the president cycle. So the first year, right, last year was a big year. So the second year tends to be either up a lot or negative. Markets tend to do what few expect. This is a quote from the video. Right now, a big year is something that no one expects. Okay, so he's trying to set us up for the idea that by the fourth quarter we should have a big run to potentially new highs. The inherent nature of second years is when they are not negative. When they're not negative, they're up a lot. Okay. So gains tend to come again on the back half of the year, not the beginning of the year. Losses in the first half of the year sets in confirmation bias for bears. So he talks a lot about kind of confirmation bias. It's a pretty interesting video. I would definitely check it out. All right. So that's the best I could do for the bulls. There were a lot more people you could talk about on the bear side because obviously the market's down. And so the bulls are kind of nowhere to be found on the internet right now, but the bears are coming out of the forest. So here are four bear cases. So Harry Dent is the founder of HS Dent Investment Management. He's written a ton of books. His foundation is demographics. So his early books are really good. They talk about when the baby boomer generation, after World War II, everybody comes back, they have kids, and you can project forward, if there's a whole bunch more 16-year-olds, you're going to have more people driving cars, more people buying cars, you need to buy bigger houses, like all that stuff about baby boomers following World War II, and that's the foundation of his whole investment methodology is demographics. So he puts out this video on March 11th, so it's really recent. So definitely go check that out. It's pretty short. There are tons of videos that he has put out. And what he's saying is we've seen a succession of tops in markets around the world, ending with the January top of the S&P 500, right? He's saying it's a classic major top. So major top meaning along the lines of the 1929 top, the 2000 top, the 2007 top, right? So after that, when you get a crash from those tops, the first crash of the bubble goes down 28 to 50%. Okay, we are nowhere near that yet. But he's saying the first leg down of a major crash is 28 to 50%. That can take, on average, 2.5 months to happen. So in his explanation, he talks about how the market needs to accelerate down basically at right now, like at this point. Otherwise, we're not in that first crash down, right? So if the S&P makes if we're not in that first crash down, then if the S&P makes slight new highs that are not confirmed by the other markets. So if the S&P turns around and makes new highs, but let's say the NASDAQ doesn't and the Dow doesn't, that's a confirmation that this major top is in place. And for him, it's all about predictability, right? So what happens on what we call the retracement of this move down that we're in right now? What happens on the retracement is going to tell him whether or not we're in the first leg of this crash down, right? If we are, right, he's saying that at the end of the day, a major crash is 70 to 90% decline overall. And he's expecting the final bottom in 2023. Okay. Tons of interesting info in there at that YouTube link. Jim Rogers, chairman of Beeland Interests, Inc., co-founder of Quantum Fund and Soros Fund Management. He was the creator of this index that's called the Rogers International Commodities Index. This video was from sometime in early March 2022. He didn't give us a specific price target, but he says that we are set up for the worst bear market and recession of his lifetime. And he makes a distinction between bear market in terms of stocks and recession in terms of the economy. And all of it is because worldwide we have a ridiculous amount of debt. He's saying that debt is what created the 2008 crash, and worldwide the debt right now is much worse than it was in 2008. Inflation, higher interest rates, and war in the short term will push prices higher or lower. When the war ends, right, the Ukraine war ends, the markets will rally, which is consistent really with debt. The markets rally some amount, whether we go to new highs or not, they rally to some extent. And then only to roll over and be followed by the worst bear market and economy of his lifetime because of this massive worldwide debt. One of the really interesting things he talks about in this video is this idea that the dollar as an international medium of exchange is being destroyed by the current sanctions policy of the administration in the U.S. So this what we're doing now in terms of sanctions, it used to be, we put sanctions on Iran forever, right? Have you ever heard of the government seizing an Iranian citizen's boat, for example? Right? We're doing things now that are changing the way the world is going to work going forward, the financial world, the way that people thought put a baseline on stuff, right? If you are a Russian oligarch now, you may have made a ton of money in whatever, and you may or may not know Putin, but if you're if you have a house or a boat or whatever in Italy, they're going to seize it from you. So what's happening is if you're some other country, you're an investor from Singapore, let's say, and you don't have anything to do with the Singapore government, but if the government does something that the U.S. doesn't like, they're going to seize your stuff. Like it takes away the foundation of how the world works, and because of that, I think everybody's probably heard this at this point, this idea that we the world pretty much has kicked Russia out of the SWIFT system, so they can't trade in dollars, right? So Russia and China are putting together their own version of a SWIFT thing, so that they can actually move money back and forth, and not do it in terms of dollars, because right now dollars are the world reserve currency, and there's a understandably big concern that the dollar no longer is going to be the world currency, and it's a problem.
Yeah, it's going to be interesting to watch that play out. I have a feeling it will not be Dogecoin.
Probably not.
But who knows?
Bitcoin, this whole thing about Bitcoin is a whole different show.
Yeah, that's a rabbit hole we can't go down today.
Can't do it today. But
we already got too much.
Yeah, Bitcoin is as a potential. There are a lot of people. One of the ideas of Bitcoin is that it can't be seized, right? It's just numbers, and you know the numbers, and you move to some other country, and that's one of the values of it. I don't know how well known this is. If you watch any of the stuff that I do, you know the Fed is coming up with a digital currency. I mean, it's just about ready to be launched. Pretty soon, there's not going to be paper dollars, and the confusion between what Bitcoin and some of the other crypto assets is versus a medium of exchange. The idea of a store of value versus medium of exchange is much different, and it's cannot go down that rabbit hole right now. Yeah,
we're probably going to have to do a series of shows just to potentially educate our listeners, who I know a lot of them because you've reached out to me, maybe not publicly, but just like, hey, where does this fit in, and what and it's a complicated topic.
Yeah.
But actually isn't. Like, you just have to understand enough about fiscal policy and things, the rules.
Yeah.
And it starts to make more sense. But you do have to kind of dig below the surface, and you definitely can't like watch the regular media and figure it out, because they don't know. They're just kind of rolling with the whatever the soundbite of the moment is or whatever. Yeah. But not to derail too much, but it is important that people understand, these policies. Like Jerry was just explaining the difference between, being able to sanction a country versus sanction a person that's attached to a country.
Yeah.
And we're not getting political or policy driven. That's not what this is about. It's just about you guys understanding those larger impacts in the economy and things to be, because we tend to 99% of the time we watch price action.
Yep.
Because we feel that that's a better indicator of what's happening in the market, because it's there. It's right there.
It is what's happening. Yeah.
It is what it is. There doesn't matter why. It's there. But that doesn't mean that there's something wrong with understanding the larger macro view,
right?
Because that can help. When you do get to a point in a price action move that you don't feel like maybe you have enough data, then you can start to expand your analysis, and you're bringing in some of this fundamental stuff.
Right.
And that can help you feel more confident about where you want to go. And again, all this stuff is based on your personal risk tolerance. We say that all the time, 100%. And it sounds kind of like just a talking point. But no, it's really important to understand your risk tolerance, because if your tolerance isn't in a place to make that decision, you need to understand why you're making it.
Right.
And what we're trying to do is educate everyone here listening to this to make your own decisions.
Right.
Get all the information and make your decision. Right. Instead of having someone advise you who may or may not know what the hell they're talking about.
It's much easier to have someone tell you what to do. There's no doubt about it. I wish people would tell me what to do, and I could do it, and I would make money, and it would be great.
1,000%. It is a very, the bottom line is what we know, and we don't try not to harp on this, but the problem is, and one of the things that made us create this in the first place, is your average investment advisor, financial advisor, however you want to term it. There's a lot of different terms. Yeah. I would say 70%. I'm being nice. 70% of them are just salespeople.
Yeah.
Meaning they truly don't understand the markets and financial policies and all of these things. They know enough to pass a test to be able to sell you, a plan, a package that's been created by people that understand this. Sure. Right. The very few people, when you're a financial advisor, they're not really the one, So I don't want to take away from the good independent advisors that are out there, because those are the ones you probably want to seek out, right? The RIAs out there that are have a fiduciary responsibility, all those things. But again, derailing a little bit, but it's important stuff to be knowledgeable enough to know how to make the right decisions.
Yeah. So one of a good way to look at that is, because this is TSP, right? You get 3 stock funds, a bond fund, and a money market. That's all you got. If the environment is conducive to the stock funds moving higher, then you should give the benefit of the doubt to the market moving higher. If the overwhelming majority of things that are going on in the world are pushing stock prices lower, then when they rally, you should be suspect of that.
Right.
Right? Does that make sense?
Yeah, are we talking about the last couple of days?
I mean,
it's a good example.
I'm just saying, the market was up huge today, 2%. It was up 2% or something yesterday. I don't know, and I don't really care what it was up yesterday. I'm looking at a chart, and I know
overall trend.
The overall trend clearly since January is down. You have all these things that are pushing prices lower. Are there going to be recovery rallies because we get oversold? Absolutely. Are you able to catch those recovery rallies in TSP? Absolutely not.
Good luck. Yeah.
So, okay.
And we move on.
That was Jim Rogers. Jeremy Grantham.
This is our third bull or our second? I'm sorry, bear. We're in the bears.
We are in the bears. I am locked on my screen, bro.
So I was thinking about earlier how 4 bears, 4 bulls walk into a bar. It's got to be a joke somewhere.
If not, we're going to make one. Yeah.
I wish I could make cartoons because we'd have a lot of fun.
Dude.
We need anybody out there that watches this, if you're good at making cartoons or little video thing, get out, reach out and touch with us. Yeah, we'd love to pay you to do it because we have some funny little tidbits that we could make into some cute little cartoons.
Yep, that would be cool. All right. Jeremy Grantham, founder at Boston-based GMO. G is Grantham. I don't know who M&O is, but GMO Asset Management. They have $118 billion in assets under management. So he puts out this video right here. Okay, my pen does work. Puts it out here on 26 January 2022. Does not give us a specific target for 22, but he says U.S. stocks are in a super bubble. He's been saying that for at least the last 2 years. Obviously, in terms of timing, he was wrong last year by a lot. But he's saying we are in a super bubble, and it's only the 4th one in the past century. So he says super bubbles can really wipe you out like 1929, right? If you guys ever looked at a chart of 1929, it looks very similar to the NASDAQ chart from 2000, where the NASDAQ was down 79% in value. And he says super bubbles can wipe you out like 1929, and that's where we are now. So blue chips are the last to roll over. It's a classic super bubble. That's a very similar bullet to what Dent had said. Harry Dent also was saying that we have seen a series of tops in different markets around the world, and the blue chip, the S&P 500 are always the last to roll over, and that's where we are right now. So Grantham is saying that we are in the buy the dip mode. You don't get 2 years of buying frenzy dying overnight. So what that's saying is since the bottom in COVID, people have been buying and buying and buying. And the Fed's printing and people buy, and the Fed prints more and people buy more. And a couple of months of correction is not going to change the attitude that people have that the market is just going to keep going higher. So from his perspective, we're in the buy the dip mode. And again, he's saying expect some spectacular rallies during this bear market. You saw it in 1929. We saw it in 2000, in the 2000 correction and the 2008, 7 to 8 correction. The market gets oversold. We get these huge rallies that don't make it to new highs. They roll over back down to new lows. It's very gut-wrenching in a bear market. And another interesting point he put out was that major brokerage houses, right, Goldman Sachs, BlackRock, the big brokerage houses will never tell you that the game is over. They have to stay bullish because that's how they make money. Okay, that's not how you make money, it's how they make money. Well worth checking out that video. And then the last one on the bears is Mark Faber, aka Dr. Doom. He's the editor and publisher of a newsletter called the Gloom, Doom, and Boom Report. He's he's a pretty funny guy. I would definitely check out the video down here. He's doing the video from his hacienda, or whatever they call it, in Thailand somewhere. No specific target for 2022. He's an old guy, and he talks about the Bolshevik Revolution and the uprisings in France in the 1600s, and he goes into some really interesting stuff. But he does a very long-term perspective of what happens when governments print money, which results in fiscal deficits. Everybody feels good. It feels like they're getting wealthier, but in the long run, it leads to disaster. So generally, the more totalitarian and socialist the state becomes, the worse the public fares, right? The worse it is for the public. Quality of life for the people decrease as the state moves to more socialist policies. Printing money leads to near-term prosperity, but eventually inflation catches up and prices move higher. Cost of living will drastically exceed wage gains. So if it costs you more to live than the wage gains you're getting, your standard of living goes down the tubes. So again, he's a character, so it's worth checking that out. Okay. So we just looked at 4 very prominent bulls, best I could do for the bull case, and 4 very prominent bears. So from our perspective, whose crystal ball is right? Right? If you've listened to this far and not rolled your eyes and be like, oh, these guys are completely full of shit, whose crystal ball is right? You got 4 bulls and 4 bears. Did you feel good about the bulls? Right? Is your confirmation bias, right? Confirmation bias is a horrible thing. If you read news that makes you feel better, you should be suspect about that. That's confirmation bias, right? So did the bull cases make you feel like, yeah, the market's going higher? Did the bear cases make you feel, oh, yeah, definitely the market's going lower, right? If your confirmation bias is one of those two, you're missing the point. What we do is respond to price movement. I don't care whether the bulls are right or the bears are right, because we're going to see it in the price movement. I can have my opinion. I can have what I wish would happen. I can have what I hope will happen. But I'm watching what happens in price because that is what's happening. Okay? I'm sure you have something to chime in about this one.
I'm trying to keep my mouth shut. I mean, I think you said it. There's we talk about it all the time. We beat it up,
yeah.
And a lot of times I think we have to just keep saying it because a lot of folks don't let it sink in what we're saying, because they immediately ask us, what should I do if?
Yeah,
and we're like, I don't know. When that happens, we can maybe figure out a little bit more, but
right.
Technical analysis, which is what we the majority of our analysis comes from, is driven by price, and you have to see the price before you can make decisions, which means there's no looking forward, only looking back.
Right.
And you have to look backwards, and a lot of people don't really grasp the difference there, where they feel like we're trying to time the market, and we're like, if we were trying to time the market, we'd be trying to figure out what's going to happen tomorrow. We have to see what happens tomorrow and see if it confirms the trend. Right. And we look, because we can only make so many moves a month, and because we only have the options that we have, the best play, and this isn't just Jerry and I talking, 1,000%. Go out and you'll hear it time and time again from people that, like Warren Buffett and all the people you want to quote. Your best bet is to be in an index funds, the larger funds, right, and follow the larger trends for a long period of time. Yep. Don't try to play the market day to day. We're forced into that. But I would say if you're not forced into that, you'd still want to play the market that way. Unless you're really educated and really understand what you're doing, the most you would do is make a few changes a month. Yeah. And we have the handcuffs off in some of our other accounts, in our IRA or our brokerage account. We have no handcuffs. We can do as much as we want. And we still aren't trading that much. Right. I mean, I follow a lot of portfolios for that reason, to see what other people are doing. And the smartest people in the world, hedge fund folks, the ones that are making billions in profits, they're only moving a few times a month at the most. Why? Because the same principle applies, right? Most people know you can't time the market. They also know that you've got to see the trend change. Yep. There's lots, day trading sounds fun. And if you're good at it, and you're able to sit there and stare at it all day, and you have all the good on you, and it's fun. It's more of like gambling than anything else. Right. But, all of it has risks. The point is we can't play that game.
Not in the TSP. No.
Right.
100%.
And so back to the slide. I mean, Jerry puts it best. Which one fits your bias? That's what's going to be. That's how you're going to. And we see that, like we got 17,000 people or so in a public Facebook group that we have, and you can see it all the time, the confirmation bias, and they're just not willing to kind of open up their aperture, open up their viewpoint and say, wow, I guess maybe I'm just kind of confirming my opinion because it makes me feel better, right? And fear is kind of driving your decision making.
Yeah, I mean. We had some people today in Facebook that, the market's gone up for the last 2 days, and people are complaining that, hey, I wish I had gotten an alert to get back into the market. I mean, so 3 days ago, the market's at a new all-time low, and you want an alert to say that tomorrow the market's going to go higher.
Yeah. First of all, let's just be clear. The alerts do not tell you what to do.
Yeah.
The alerts 100%. Are what we do.
Right.
Please understand that. The alert is telling you what we're doing with it. First of all, go find anyone in this industry that's telling you what they're doing with their money. Good luck with that. But we do that out of transparency, because through education, which is what we're trying to do here, being able to see where we move our money in the TSP lets you validate your own decisions. That's the idea. Is we give you the education. Now you get to look over the shoulder of someone that is really actively managing their TSP, their retirement accounts, and you see what we do, and you can go, okay, well, it's like the math teacher giving you the answer to the problem. You going, oh, I see where I messed up, or I see I got it right, or whatever. That's what those alerts are for. We're not telling you to do that. We're telling you that's what we did, and you've got to use that as more data to figure out, does this move work for you? Right?
100%. 100%.
All right, man. Let's get into commodities. I'm actually waiting for this part. I want to talk about commodities.
This is so there's been a lot of talk, right? Gas prices obviously are going through the roof. There's a lot of talk about gold. Is it or is it not a good hedge against inflation? And then we all know that food prices are going up ridiculously. So how is all this stuff reflected in price charts? So here's a chart it's a 2-year weekly chart of the XOI, right? It's the oil index. I've used the RSI line probably for the past 6 months as my primary sort of tool, right, to complement price. So here we are back here at the low in COVID for the XOI. It's way oversold, right? It comes up and hits that 50 line in the RSI. And if you've heard us talking about it at all, that 50 line is really, really important. It's not 50 to the penny. It's, this is as much art as science, but the 50 line is critical. So we are way oversold, okay? Price comes up on a percentage basis. It's a lot because it went from 500 up to, it almost doubled, right? So price almost doubles, but the power behind that move could only get us to the 50 line on the relative strength. And so then when we had this big reversal candle right here, it was pretty clear that price was going to come back down lower, right? So it comes down, can't get above the 50 line. Price comes down, RSI comes back down, and then we get a pop, right? Back here in November 2020, we get a huge gap up, and we have, you see the angle, the up angle of that move. It's a measure of the power of the move. So even though it didn't get above 50 at the very beginning, the angle and the gap up told you that price is going to move higher, right? So once it gets above 50, it stays there for quite a while. So now we get this big move in oil, okay? And it rolls over, and it gets below 50 here, right? So maybe you got shook out a little bit on this week. If you're looking at the chart, that 1,000 level was critical, right? Once we got back above that 1,000 level, we got this big breakout. We're back above the 50 line, and oil's going back to new highs. Is this candle where we are right now? Again, this is the middle of the week. RSI is rolling back over. It's not below 50. If you drew this trend line, are we going to get support there and go higher, or does it go lower? Maybe you think about what's going on in the world. Do you think that oil prices are actually going to come back down from here? I don't know. You draw this trend line. If oil prices do come back down, we're going to get down here below that trend line. That'll be great at the gas pump, and it would be the time to sell oil stocks. This is a pretty big indicator right here. That reversal candle is pretty huge. So to be honest, in the relatively short term, right, because we're starting this pretty much on January 1st, if we drew out a longer trend line, things would be a little bit different. But in the short term, does it look like, if we break this trend line, does it look like prices at the pump should go down a little bit? Yeah, it kind of does. Can it come down and hit this longer term trend line and then go higher? Absolutely. Would that correspond to RSI coming down to the 50 and then moving higher again? Yes. So people say, is this a guessing game? It's an educated guessing game, right? Okay, that's oil. Gold. Everybody's talking about, not everybody, but if you're following this stuff, there's a lot of people they call them gold bugs, whatever. Here's gold back at the end of COVID. It's down here at like $140 on the GLD. It's the spider. It's the S&P Gold Index. It has a huge run, right, in an ABC. So if you're familiar with Elliott wave patterns, an ABC is corrective. It's not an impulse move. It would have been much better to see to see a 1, 2, 3, 4, 5. That would have been a much better move if we thought that gold was going to continue higher, but it didn't. It did a corrective pattern, 1, 2, 3, and then price rolled down. We got above that 50 RSI line. Huge move in price, got overbought. Price rolls over, eventually gets below that 50 line. We're down here a little bit, get back above it. I mean, you can connect the down sloping trend line and see kind of where price is on a weekly basis. At the end of the day, we have higher lows for months, right? So if you had connected this trend line, you have higher lows and you have increasing RSI, right? So down here, it's not below 50, or it is below 50, but every time it comes down, it doesn't get new lows. So we have an increasing RSI line and increasing lows, and volume is increasing here. Then we get the breakout, right? That's the time you want to be buying gold, on the breakout. So say you buy gold on the breakout, right? In February, not that long ago. Huge spike up, almost hits $200. And that giant reversal candle is frightening. For the week, it almost got up to $200 and then reversed all the way back down to almost where it opened. And then the next week, huge negative. So is this just a bull trap in an overall bear market for gold? I think you have to assume that that's true. Because why? We didn't take out the highs. We were close, but we didn't take out the highs from 2020 in gold. So can gold come back down to the trend line, get support here somewhere, 172 maybe, and then move higher? Absolutely, and that would be great. Because if we drew the line and we got support down here and got a pop higher, that's another great time to get back into gold. Okay. Agriculture. Everybody knows food's getting more expensive. This is what it looks like in terms of price. Huge price move higher following COVID, like everything else. Price comes up. We got a pretty shallow consolidation pattern here. And the prior high at 60 is definitely significant, right? We hit 60. We get a little bit above it, we come back down, test it, come back up, test it again, and then right there is the breakout, right? Once we get above 65, it's often running on giant volume. So far this week, we have a little bit of consolidation from that huge move, but I actually bought an ETF called VEGI, VEGI, back in here. I didn't buy the agriculture index. I bought an ETF that kind of follows the agriculture index, and I am absolutely still in that trade. So hopefully that kind of gives you a little bit of perspective when you hear about commodity prices and gold and inflation and all that kind of stuff. What's happening? This is what's actually happening in terms of price.
And the only way you could find that out is by looking at the actual price data. I mean, you can look at a lot of opinions, or you could just look at the data.
Yeah, I don't know how people function without looking at charts. I just don't.
Yeah, I mean, I functioned a long time before I met you, and started following these various things. And at some point, you just get educated, and you realize that I can listen to a lot of opinions, or I can look at data and make the decision myself.
Yeah, the thing that I get all the time is, okay, so if this line crosses that line, then I should do X. And as much as we talk about that, like the RSI line above 50, below 50, whatever. Yes, RSI above 50 or below 50 is critically important, because that's the time when you really have to focus in and see what's happening and decide whether or not you want to make reallocation decisions. It's not that if if RSI gets above 50, now I'm going to buy it. That's not the point.
Right.
The point is when it gets above 50, actually, hopefully, you're watching it as it approaches that line. And when it gets above there, you're looking at what price is doing. You're looking at what volume's doing. Does it get to 50 on decreasing volume? You should be suspect.
Right. Because we start with price and volume.
Yep.
And if you guys, we do a little charting series. It's on our website. You can go in under our videos or our, I can't remember now what it's under, but it's there on the site. Yeah. And you guys can see it's a 4 or 5 part series that we did. We start with price and volume, and then we start to move to other indicators. Indicators, and RSI happens to be one that Jerry uses a lot. But I will say, like we talk about having lines in the sand. So that line in the sand is just a point at which you're watching all these data points to say to yourself, if it gets there, it's not necessarily as simple as these 2 lines cross.
Right.
Although that is definitely one of those pieces.
Yep.
And you should have these kind of figured out to say to yourself, okay, if all these things happen, and here's where we are, that's my line in the sand.
Right.
And if you're not confident, there's nothing wrong with giving it another day.
Right.
Jerry does it all the time.
Yep.
There are people sitting on the edge of their seat, and Jerry does it because he's going to confirm the trend.
Yep.
And I respect that because, you don't want to do it out of fear or anxiety.
Yep.
You want to do it out of information.
Yep.
And if you go, okay, it hit it, but it didn't hit it hard enough. Let me let it play out for a day. Oh, there we go. That's exactly what I was looking for.
Exactly right. Exactly right.
Let it play out. It's not going to, well, knock on wood, it's not going to impact it enough that you couldn't get out. You can't, mostly because we're playing in the TSP, you can't sit here and worry about, a few percentage points when you might have saved yourself 30 points.
Right. So the F fund alert and allocation and stuff, if you guys are subscribers to the site, we got into the F fund for, I don't know, a couple days, a few weeks ago, because the F fund hit a series of support levels and broke higher. And I got back into the F fund 50% for a few days because it rolled over. And I had my line in the sand was 109 on the AGG, right? The F fund, it went up for 2 or 3 days and rolled over and got below the level that we got in at. And I had a lot of people saying, well, why not get out of it? And I'm like, because my line in the sand is 109. If it gets to 109 and does a double bottom and goes up, then great. If it gets below 109, I'm out. That's my line in the sand. I'm not getting out before then. I'm going to give the market the benefit of the doubt.
But it wasn't just about 109. It was more about all the data that led you to 109.
Yes.
That's the important part, I think, for people to realize is Jerry didn't pick 109 arbitrarily. It was a line that said, okay, the only way we're going to hit that point, or if it hits that point, all these things are in play. All these things have happened. And that's enough information to tell me it's time to get out.
Right, time to get out.
Yeah.
And so on the day that it broke 109, it broke down hard through it, right? So we took a bit of a loss on that trade. But if it had found support at 109, which if you go back and look at it, that there's a lot of, the market kept coming down to 109, went higher, coming down, went higher. We had 3 weeks of consolidation there, and then it popped higher is when we bought it.
Yeah, we walked through this in our monthly performance call with our members. So if you remember, that's posted. You can go watch that replay video. We do the webinar with all the members, and we walk through each and every alert and that we've done, so you can see the
exactly
rationale.
Why we did what we did.
Yeah. That in and of itself, that one call every month, I hope people kind of soak that in. That one video, that one, we do it in webinar format so that if you want to go live, you can ask us questions during it, but then we record it and we put it up on our site for members. But that one call is huge education because you're able to walk through all these decision points and kind of look backward and go, oh, okay, I got it, right? I understand why we did this. I understand what to look for going forward. It's huge.
Okay, so we're wrapping it up. Here's still the only chart that matters. We've been talking about it for weeks. Why is it the only chart that matters? If you're a TSP investor, you're just, at this point, you're probably not watching this show. But if you're still watching and your eyes haven't completely glazed over, here's the bottom line. If you are a TSP investor and you're only looking at the market once a week, here's a 2-year weekly chart of the C fund. Okay. Here's the bottom in COVID. Once we got back above the 20-week exponential moving average line, every time we had a little correction in the market, we got support at that 20-week exponential moving average line. Every single time over the past 2 years until early January, when we broke that, we closed for the week below that 20-week exponential moving average line. Okay. That was the first indication that a major trend change was possible. It doesn't mean it had happened. It just means it's possible. Since then, every time the market has tried to get back above that 20-week moving average line, it's gotten pushed back down. So now, where it was support for price here, it's resistance for price here. So until price on a weekly basis gets back above this blue 20-week moving average line, there is no hope for a sustained long-term rally. There's no hope that we're going to new highs because obviously we have to get above this line to get above the new highs, right? We're not trying to catch the bottom of the market. We're trying to be on the right side of the market. I don't know how else to kind of explain that, and I apologize if I'm coming across as frustrated because I've been on Facebook all day and I am a little frustrated. So
Facebook will do that to you.
Jesus, bro. People want me.
Woosah. Woosah.
If
If anybody knows what movie that is, put it in the comments.
If Jerome Powell doesn't have a crystal ball, neither do I.
Right.
Jerome Powell, in case you don't know, he's the chairman of the Fed. If he doesn't have a crystal ball, I damn sure don't have a crystal ball. Right? I'm just trying to be on the right side of the market. And
so far we have.
So far we've done pretty good. So RSI is way below the 50 line. You got giant volume on down weeks. Until we can get on a weekly basis back above that 20-week moving average line, there's no reason to be in the stock funds.
You have to have, if you watched that last slide and you took nothing else away from what we've been talking about, you have to understand, that there is no reason to be jumping into the market. If you follow this methodology, if you even remotely follow this methodology, and when I say this methodology, I don't mean Jerry and I's methodology, right? It's the idea that you can only follow the trend once you've seen the trend. The pattern has changed. Right. Once the pattern changes, then you can identify it. Then you can identify it. You can't guess it. You can't do it before. Right. You can't, particularly in the TSP, you can't be in and out, right, and expect that you're going to be able to play that. Right. You just can't do it. Now, if you're in an IRA account, if you're in a brokerage account, and you want to play that dance, and you want to watch the market throughout the day to make those kind of changes, great.
Yeah, dude. So to be fully transparent, I made a ton of money today.
I'm happy for you.
It's Wednesday.
You're buying the beer tonight.
Yeah, I can buy the beer tonight. Today the market went up and down and every which way, right? I was literally sitting in front of my computer with my Fidelity tab open and my stock charts tab open, and I'm watching the 2-minute, the 1 day 2-minute chart, and I'm drawing my resistance line, exactly what we're talking about on the show.
Yeah, you're just zooming in.
And I zoomed in.
Yeah, but we're able to do that outside of the TSP.
Yes.
You can't do that in the TSP.
You can't, but it's the exact same methodology is what I'm
100%.
saying. Exactly the same.
Yeah. I mean, Jerry talks about it all the time when we're not on the show, when he and I are talking about, how we use this methodology in our day-to-day lives and investing, and it really doesn't change.
It's the same.
The only difference is the time frame you're doing it in. And whether you're able to take advantage of the ups and downs. Yep. Even when you do go micro and you go, you zoom in, if it's too, here consolidating, looking like this, that's too hard to play.
Yeah, you just wait for it to break one way or the other, and then you buy it.
You need this. You need a little of this. You got to, because there's no other way. There's no way to see a trend change, whether that trend is daily, weekly, monthly, yearly. Yep. And in the TSP, we're playing more like yearly, if not multi-year. Right.
I tell you, you had a good point.
It's rare. It's very rare.
I guess it must have been on the last show, and if it wasn't, it was somewhere else we were talking about.
One of the hundreds we've done.
The noon rule I mean, the 2 move a month rule
Yeah.
is bad, but the noon rule is worse. I mean, it's you.
If you could give if somebody would give me one wish,
Yeah.
when it came to the TSP, that would be the one. Because if we just had till the end of the day,
Yep.
and it's not a lot to ask.
I don't think so. How about 3:45? Not even 4 o'clock. Just 3:45.
I don't even want the closing price.
Right.
Can you give me the almost closing?
Right. Almost
price?
closing.
We literally would make a significant amount of we would have a much better return.
Yeah.
Because you are, whether we like it or not, we are having to guess
100%.
what's happening afternoon. We don't have a choice.
Right. We don't have a choice. It's
And
the rules.
really, it opens at 9:30, and we got to make that decision by 11. That's like an hour and a half.
Yeah.
Did I do the math right?
Something like that. I mean, come on.
Come on, man.
It's very,
tough.
very difficult.
All right. This is one of the few lately that we've actually gone over an hour. If you have any questions, you can put them in the comments section of wherever you find this video, whether that be YouTube, Facebook, Planet Mars, wherever you find it.
All of them.
Put it in the comments. On our website, if you watch it right directly from our website, I don't know that there's a place to put comments. So what I would say is just click the video and you'll go to YouTube and you put the comments in there. It does sometimes take us a few days to get to it, sometimes depending on how busy things are. And if it's a question about something specific to your circumstances, it's very unlikely that we will answer it because we're not giving financial advice.
Right.
We're trying to educate you on how to manage your TSP. And if you give us a general question, we'll do our best.
Yep. And if you want to know what we're doing with our TSP accounts,
subscribe
to the
we'll
site.
tell you, and we'll also, I mean, I tell people that, like, when people ask me about what we're doing here, I tell them the alerts are like icing on the cake to me.
Yeah.
You don't even have to, you could just read the Sunday newsletter, watch Jerry's video walking through the newsletter, the walk and talk we call it, and that's it. If you did that once a week, you could sit down with a couple of simple charts, figure out your plan, go back to work.
Yep.
And you are going to grow a significant amount of money in your TSP.
Yep. This is a long-term game, right? So if nothing else, if you're not interested in all the other stuff we talked about on the show,
just the Sunday newsletter.
The only chart that matters.
The
right?
only chart that matters.
It's the only chart that matters for a reason.
I actually know quite a few people over the past few years that we've been doing this that tell me they're like, yeah, I don't obsess over the alerts. I just either Sunday or Monday, right? Because sometimes they don't even watch it on Sunday night.
Yeah, sure.
They'll wait till Monday. They watch the video. They're like, okay, if this happens, this is where I'm going. If they got a plan, and that's what we just tell people. Got to have a plan. All right, we've hit it on it enough.
All right.
If you guys liked it, share it with your friends. If you didn't,
Happy
share it
St.
with your
Patty's
friends.
Day. It's tomorrow.
Oh yeah. Well, it was a few days ago. Once you're watching this.
Yeah, but if you're us, it's tomorrow.
Take care, guys.
Cheers, everybody.